Hello and welcome to Snowflake's End Data Disparity movement. Data allows us to better understand and improve our world. It should represent everyone, but many groups are being partially or entirely left out. And that is what today's conversation is all about. I sat down with Elena Philipova, Director of Sustainable Finance, Data and Analytics at the London Stock Exchange Group, to dive deeper. Enjoy. Elena, such a pleasure to be with you here today. How was your experience leading ESG initiatives at major financial data companies like LSEG and Refinitiv shape your perspective on the evolution of sustainable finance?
It's a great question, Ryan, and I must actually admit that I feel extremely fortunate to be working at the epicenter of change, at the intercept of investors, regulators, and global businesses, and seeing how those different stakeholders have come together to challenge the status quo, to experiment together, trial and error, and work together to transform the global economy. And that journey has been absolutely fascinating. It surpasses all of my bravest career dreams and expectations when I started my career at ESG and sustainability 20 years ago. Working at a major data provider like LSEG is critical because we're the glue that brings all those pieces together and energizes the change. Change is driven by information and data, but it's driven by knowledge, and we empower users to have that knowledge and make more informed investment decisions, regardless really of their investment styles, philosophies, morals, and beliefs. And what gives me hope at the current quite volatile and uncertain time is that what we see in the market is a continuously growing demand for intelligent information.
Great insights and perspective, Elena. Can you share an example of how you've successfully integrated ESG data into traditional financial products or services to drive more sustainable investment decisions?
I will probably start by saying that my approach to ESG data has been the same for 20 years. I'm sure not many people be able to say such a thing because ESG has dramatically changed in the last 20 years. But the approach is very simple. ESG has to be embedded in traditional financial models and processes to enhance financial analysis, not be competing with traditional financial processes or be done in parallel to them. At LSEG, for example, we integrate ESG and very granular climate data in traditional portfolio analytics workflows and applications on our desktop products. We create customer specific templates that adjust traditional financial metrics and analytics for greenhouse gas emission exposures across investment portfolios. We enhance traditional StarMine quant models for ESG to capture, for example, better signals based on expected investment behaviors. And these are just some of the examples of how we integrate as a data vendor ESG data in core financial models and processes, which we very firmly believe enables users to unleash the benefits of the data.
Great to hear, Elena. What's the case for ESG or sustainability focused investment? And what works, what doesn't work, and what simply needs some fixing?
I think it probably makes sense to unpack the meaning of ESG investing. In my experience, I've seen a lot of people interpreting it differently. And simply put, I think ESG investing is smart investing. It is core to any business, regardless of the sector and geography, just like other intangible assets like innovation or brand reputation are. And we know that intangible assets often have greater value than tangible assets. So it makes a lot of sense and it is at the heart of the business. But in terms of what works well in sustainable finance specifically, I find it quite fascinating to say that the demand works really well. We're in a very interesting situation where the demand surpasses the supply. There is more demand for sustainable solutions than the supply out there. And I think that's a good problem to have. In terms of what doesn't work. In my view, financial services industry and capital markets are trying to solve a problem that's bigger than their remit. Solving our generation's greatest problems like deforestation, poverty, is probably not the job of capital markets, or at least it should not be led by capital markets. There are scientists, politicians, the public sector that need to be showing the pathway, and capital markets enables, fuels that pathway, but shouldn't be the one actually sitting behind the driver wheel. And I think that is where it doesn't always work well. And in terms of fixing, I um, I believe that it's skills and education, and this is a low hanging fruit. And we're definitely not moving as fast as needed to empower the industry with the knowledge and skills required to change status quo and understand the new emerging risks of our society. By introducing such courses in universities, the new entrants into the workforce will have the knowledge, the ammunition, and will be able to jump straight into doing the job well.
It's an exciting next chapter indeed, Elena. Where do you see the largest gaps in data collection, and where are we currently, say, quote unquote, flying blind when it comes to ESG?
I like that analogy of flying blind. We definitely do feel like we're flying blind from time to time, which can be discomforting, but we need to get used to not always being comfortable, I guess. Um, but I probably will highlight one key characteristic of any data that is foundational for investors, and that is comparability. Comparability of ESG data as well is foundational for investors to do well sustainable finance. And one of the key challenges with ESG data is the lack of common definitions and commonly agreed methodologies. What ends up happening is we use the same term, but describe two different or many different things. We see that in company reports as well. One number commonly labeled, but meaning quite different things, applying different methodologies to calculate the number. And this puts actually a lot of pressure on data providers like us at LSEG to produce the data that is required, but equally on investors, the users of the data, to actually use the data with confidence across their investable portfolios. So I think that probably is one of the biggest challenges that remains at the heart of ESG data today. In addition, if we think about data disparities in ESG data, there are quite a lot as well. And we as an industry are not doing a very good job in addressing those gaps and disparities in ESG data. And those range from things like geographical representation in ESG data. And it's well known and documented that there is a bias towards developed markets versus emerging markets. Simply, there is more data coming in from companies operating in developed markets versus companies operating in emerging markets. And similarly, company size biases, in particular around listed and unlisted companies. The demand for unlisted company ESG data is at all-time high, and the availability of such data is very, very scarce.
Great perspective and insights. Elena, AI is top of mind for everyone really across the board. And in your opinion, what role will artificial intelligence and machine learning play in enhancing ESG data quality and analysis for financial decision making in 2025? And what are some of the ways we can use new and expanding technologies to improve these outcomes?
I think that's an excellent question, and one that's been keeping us, and I'm sure the industry at large, very busy. Um, and I'll be frank with you, Ryan. I think sometimes I get a little disappointed when I see that some focus on AI-enabled technologies and view it as an enabler to productivity primarily. In other words, producing more data more quickly, less people, and that's really the number one objective. So AI being about speed and volumes. And I think especially in the context of financial services and investment decision making, that is the wrong approach. For us, AI is an enabler to our people to produce intelligent data, to produce intelligent information. And we are introducing AI powered solutions throughout our processes and workflows to replace the more mechanical tasks, the lower value activities that our analysts and developers spend their time on, to actually empower our experts to do better their job, and thus provide our customers with the data they need, when they need it, where they need it. So AI really enables experts to be better and go deeper rather than go faster.
I love that message, though. That's so pivotal to the audience watching, because that's really, at the end of the day, what it's all about.
Absolutely. And I think many people lose sight of that key differentiation between speed and quality.
Elena, I want to continue to look down the road and continue to examine your predictions here. Given your extensive background in ESG data quality management, what advice would you give to companies looking to improve the accuracy and reliability of their sustainability disclosures?
How much time do I have? I have a long wish list. No, I'll keep it short, I promise. Um, I think probably number one is report and be transparent, because even today, where we have multiple standard setters creating standards for ESG data, we've had companies providing data through surveys and questionnaires back to their stakeholders for decades, and still the availability of data is quite low. So, number one is report and be transparent of what you're reporting and what you're not reporting. And it's important for companies to know that if they're not reporting the data, someone, and probably not only someone, many people out there will be estimating it on your behalf, putting your company at disadvantage. So it is not a good strategy to be quiet and not disclose. Then, in terms of how to improve the quality and usability of the information, especially in terms of investors, as focusing on that stakeholder and user of the information, it's critical to remove uh, ambiguity and opaqueness from the reports as much as possible. There are always company specific nuances, but we as readers of the report sometimes feel that companies on purpose create lack of clarity to confuse readers, and that's really not helpful. The next thing is follow industry standards, methodologies, and terminologies. We spoke about it. It's critical to be able to produce data that allows users of the data to fairly compare you to your peers. So it's important to be following industry-wide standards and definitions. Another key consideration is just continuity of reporting, and consistent reporting year on year is critical. It's important to remember that products, instruments, ETFs, benchmarks, they are rebalanced quarterly, semi-annually, annually, and they always use the latest data. If there is volatility in the reporting, that inevitably leads to volatility in how the companies are represented in financial products. And sometimes it's not representative of what's happening actually on the ground in companies. So consistent reporting year on year is very important. There's been a lot of talk in Europe around CSRD and digital reporting powered by XBRL. We believe that this is a key enabler to improve quality and timeliness of ESG data. So building the structures and processes internally to produce digital reporting in the short term is critical to improve the way companies communicate with recipients of their data. And even if it's not digital reporting, at least structured reporting in a table format. And that's similar to the ESRS standard in Europe in a table format that improves significantly the usability, discoverability, and accuracy of the data. And probably last, calling out also the indexing of reporting to standards and including item codes. We've seen that companies that provide indexes in their reports, they tend to have the most impactful and highest data quality communication practices to data providers, investors, and all stakeholders.
Based on your work with regulatory bodies like the European Commission, what do you see as the biggest challenges and opportunities in standardizing ESG reporting in metrics globally?
I think that it's probably unrealistic to expect that we're going to have one global standard for ESG data. And if we leverage and reference financial reporting as a benchmark, as we know, sustainability reporting is a couple of decades behind financial reporting. Even with financial reporting today, there are multiple standards, and that's okay. That's not a problem. What is critical, though, is interoperability across those reporting standards, because companies, businesses operate across country boundaries. And we need to give them guidance on how to consolidate their country specific data on a consolidated basis and report it regardless of the standards. And what, again, is very encouraging for me in seeing the debates and being part of different standard developments across the industry is the desire to create interoperability. I think as an industry, we've realized that the fragmentation has been more of an enemy than a friend. And there have been very good examples of consolidations and public efforts and collaborations to introduce on interoperability across different leading standard efforts. So I'm very hopeful that that's happening and it's coming. And that should enable and simplify the reporting journey for organizations around the world.
Thank you, Elena. To your point, an exciting next chapter, and I want to continue looking forward-looking predictions with you. What emerging ESG themes or data points do you believe will become increasingly important for investors and companies to both focus on?
I think I'll probably be very straightforward with that question. And from my perspective, it's the alpha generating ones. Um, in general, ESG, climate, any of the sustainability thematics are cyclical. And we know climate strategies, for example, have in recent quarters underperformed the market. And that's normal because they are cyclical. So the thematics and the data points that are giving the right signals will be the ones driving more demand and importance for investors. I think we'll hear a lot less from the industry on new areas that they're venturing into or working on. Like there was a big hype in recent years around biodiversity, nature positive strategies and products. That definitely has quieted down. And I think that it's all for good reasons. Going back to the primary purpose of capital markets, which is to deliver good financial performance, and still align with sustainability objectives and mandates. So yeah, I do expect that we're not gonna be hearing a lot about new thematics in 2025.
Well, Elena, it's always a pleasure to speak with you. Before we go, I want to call your attention to a recent BNP Paribas survey that found that 71% of respondents said that the quality of ESG data was the biggest challenge in integrating ESG data into investment processes. How can we collectively ensure the quality of data is accurate?
Probably I'm going to undermine the effort in responding to that question. And there's been a lot of monumental effort happening across the industry, across both the public and the private sector. I think that it's because of that feedback from the industry. European regulators, as example, have started a series of sustainable finance regulatory initiatives in recent years to address some of the concerns around data quality that the industry has been raising in terms of regulating ESG rating providers, in terms of the different codes of conducts that have been launched, and LSEG and our peers have committed to. Um, so a lot of effort is going into improving data quality. From my personal perspective, the most important thing is focus. We tend to try to run before we walk, or let the perfect be enemy of the good, and try to solve for all problems and all potential sustainability risks at day one. And as such, there is currently a lot of pushback from the industry on ESG reporting that we're experiencing. I think it's very important to focus on a smaller number of metrics that are critical and most important to investors. Get those right, and only then move to the next level, which tends to be more challenging and requires more time to do well. So I think that because we've tried to do everything in one go, we've done everything on an average level. Um, and I think we've learned. That's why at the beginning I mentioned we're learning together as we go. We're going through trial and error together. But I'm firm believer that what counts are the incremental steps in the right direction. And data quality is definitely moving in the right direction. And I'm very hopeful that we're going to yield the right results as we continue staying focused on the changes ahead of us.
Elena, to your point, we're very much all in it together. Thank you so much for your time and your perspective and diving deep into all things and data disparity. Thank you again, Elena.
Thank you so much, Ryan, for having me.
And for the audience watching, thank you so much for tuning in. We'll see you soon.